Good evening, students. Hope you can hear us and see the video as well. Welcome to Ekcel Academy's live session for CMA, more specifically marginal costing. This was requested as one of the topics to make a video on. So we are looking at marginal costing for today's live session. Now let us look at the introduction part and then we'll proceed towards a few problems. Let's see what exactly they got to say. Marginal cost, the change in total production cost that comes from making or producing one additional unit. Very simple definition. So whatever we spend to produce one extra unit, so that amount is referred to as marginal costing. As the name itself says, it is margin. So what is the margin between one product to another product? So that will be 1 unit if you are producing 10 units, and if you are spending, let's say, 100 rupees, and if you are producing 11 units, and for those 11 units if you produce 110 rupees, if you spend 110 rupees, then the marginal cost would be the difference between 110 and the 100 rupees which we spent for 10 units. So the difference of cost, which is 10 rupees, would be our marginal cost. Once again, the change in total production cost that comes from making or producing one additional unit. As simple as that. Let's move on. How much will it cost to produce one extra unit? That is the whole thing here. Let's say 90. Again, similar example is given here too. So for example, 90 units costs 90,000 rupees, and if 91 units costs 91,000 rupees, so what is the difference here? That is the whole funda about marginal costing. So 1 unit will cost 1,000 rupees. Now again, in case of marginal costing, we have two different costs here. One is the fixed cost, the other is the variable cost. Again, in variable cost, we'll have different types of variable cost, which we'll see. For example, direct labor could be one variable cost, direct material could be another variable cost, and maybe variable overheads, other variable overheads. All these are variable costs which vary with the level of production. Whereas in case of fixed costs, which is also part of the total cost, the cost pretty much remains the same, or we can say the cost remains fixed, or at least some period of time. It's not as if the fixed cost will be fixed forever, because nothing is constant in the long run. So therefore we say at least in the shorter run something will be fixed, or the cost will not change in certain circumstances. So those costs will be considered as fixed cost. For example, rent. So rent you pay for the factory building, or the salary which you pay to the employees, doesn't really matter how much you produce. Maybe if you are producing 100 units or 110 units, the salary would still be the same. Even the same thing with rent. If you are using the entire space to the fullest capacity, or maybe even if you are using only to the extent of 50% capacity, the rent which you pay will still be the same. So therefore in such cases we say those are fixed costs, at least temporarily. So that is the thing with respect to fixed and variable costs. Moving on. They say profitability of departments, products, etc. is determined based on their contribution margin. Now what is this contribution margin? That's a new word here. So what we have understood here is there are different departments, and different departments have different profitability levels, and those profitability levels are determined based on what? Their contribution margin. Now what is this contribution? Very simple thing. It is nothing but our sales minus the variable cost. So whatever is the sales value and whatever is the variable cost, from sales value, if you deduct the variable cost, whatever is left will be our contribution or contribution margin. So let us look at the formulas used here. Sales minus variable cost, just now we saw, that is contribution, that is one thing. And sales minus variable cost can also be written as fixed cost plus profit. The reason being, if I have to explain that, so if I have to draw a statement here, sales minus variable cost, let's say this is 100 rupees and variable cost is 50 rupees. My contribution would be 50 minus the fixed cost of, let's say, 20, that would be 30 rupees of profit. Now using this example we can write down various formulas actually. For instance, sales minus variable cost equals contribution. Likewise, contribution equals fixed cost plus profit. If you look here, my contribution of 50 is nothing but fixed cost of 20 plus profit of 30. So that is what we saw here. I hope it makes sense. If at all you have any doubts with respect to any of the things which we are discussing here, you may ask the doubt in the form of chat. That goes without saying, but even though I'm saying. Anyway, moving on. Sales equals variable cost plus fixed cost plus profit. Again, we'll have to go back to this. Sales of 100 rupees equals variable cost of 50 plus fixed cost of 20 plus profit of 30. So that is another formula. So if you remember this statement or statement with any example, so you can also easily remember the formulas. So one thing which we can use to memorize certain things would be associating or giving examples for the things. For example, in this case, what I've done is, instead of just writing sales minus variable cost is to something, I gave the example. Even in the exam, if you have to recall something, think of an example. It will be much more easier for you to recall the formula. Then contribution equals fixed cost plus contribution. Fixed cost plus profit. So contribution 50 is equal to 20 plus 30. That is fixed cost plus profit. So these are the basic formulas which we saw. Let's move ahead. Now contribution we have already seen, sales minus marginal cost or excess of sales for variable cost. So that is in terms of sentence. Okay, there is nothing much here. Let's move on. Here is an example. We have an example of sales is 80,000 and variable cost is 50,000 and fixed cost is 20,000. It's easy to calculate contribution here. All that we need to do is from the sales deduct the variable cost. So sales is 80,000 and minus variable cost is 50,000. We'll be left with contribution of 30,000. That's it. Anything much? No, nothing much can be done here anyway. Then profit again can be rewritten based on the same formula. Profit is nothing but contribution minus fixed cost, or if I have to write it in the form of a statement, sales minus variable cost would be contribution, that minus fixed cost would be profit. So in this case, in the previous page, we saw the contribution was 30,000. From that 30,000, if you deduct fixed cost of 20,000, you will be left with a profit of 10,000. That's it. Next. Now here we have contribution ratio. By the way, all these are formulas which will be useful in exam, because this is a fit chapter for MCQ questions. There are various chapters in the syllabus which are not actually fit for MCQs or objective type of exam, but this is one exception. So it is possible that the institute will ask many questions from this chapter, and they have in the past. Let's look at contribution ratio. So this is a different formula. This is nothing but how much is sales contributing. So that is the thing, with every additional sales, how much in returns are we getting compared to the variable cost. So there is a formula for that, very simple one. Contribution ratio is nothing but selling price minus variable cost divided by selling price. So if I have to rewrite it, let's say my sales or selling price is 100 and variable cost which I have to deduct is 30. So my contribution will be 70. Now just now we saw contribution margin, contribution ratio is nothing but sales minus variable cost divided by sales into 100. Or you can also write, instead of sales minus variable cost, I can directly write contribution by sales into 100. That is also fine. So if you do the math, you will get the ratio here. Contribution in our case is 70, sales is 100, into 100 will be nothing but 70%. My sales is contributing to the extent of 70% when it comes to contribution. That is the thing. By the way, this contribution ratio is also known as profit volume ratio. So in the exam, they may ask you to calculate profit volume ratio or contribution ratio. Both mean the same. There is no difference between the two. Most often they use the word profit volume ratio or PVR, but sometimes just to confuse you, they may even call it as contribution ratio. Just be aware of that. That's it. Again, there is one more example. Let us look at this. Yeah, selling price is 50, variable cost is 30. So that is what we need here. Selling price minus variable cost. So selling price minus variable cost in our case is 20. So that 20 is nothing but contribution basically. So contribution by divided by what? Divided by selling price or sales. In our case it is 50. So 50 and multiply that by 100. So 20 by 50 into 100. So it will be 2 divided by 5 percentage. That will be 40%. That's it. I don't think there is any doubt about these things because these are all pretty straightforward. You just look at the formula, you apply, substitute the values and just execute it. Let's move ahead. Again, the same thing is here. Net profit, all these things are done. Okay, here's an interesting experiment. What if the sales increases by 100 units? Let's go back to the previous example. How many units were sold? 1000 units. Let me just bring up one more screen for my calculation. So now, just give me a second. If the text is not visible, please do let me know. I will zoom in. But right now, what do they say? Let's go back to the problem. Sales units is 1000. Okay. So we are selling 1000 units. And contribution ratio or PV ratio, which we have already calculated, is 40%. This is already calculated, that's why I'm not going to calculate again. Okay, let's go back to the problem now. Now the situation which they are imagining is, what if the sales increases by 100 units? That is the situation. Okay, so now if the sales increases by 100 units, instead of 1000 units, we will have 1100 units because it is increasing by 100. So then selling price per unit in this case is 50 rupees. So therefore total sales volume would be 50 into 1100. Okay, so this will be 55,000. Now what about the contribution? Will contribution also increase by the same amount? Let's see. So 55,000 is my sales minus variable cost. So how much was the variable cost in our case? Variable cost is 30 per unit. Okay, let's go back. 30 into 1100. So which will be 33,000. So now 22,000 is my contribution. So earlier, how much was the contribution? The contribution in earlier case, where is that? Was 20,000. Now it has increased to 22,000. So the whole point here is, since the sales increased by how much was the sales increase? Where is that now? Yeah. Then 1 second. Sales earlier was 50,000 and contribution earlier was 40% of this, which was 20,000. Okay, so now when we are calculating contribution with increased sales, we don't have to do all this. That is the whole point. We can simply look at the sales value. The increased sales value is 55,000. On that, simply apply percentage of 40, which is our contribution ratio or PV ratio. So now, which will be nothing but 22,000. That's it. Once again, I need not have calculated all this because I already know how much is my PV ratio. If I know my PV ratio, there is no need to calculate sales minus variable cost again for different levels of production. Just look at this sales. So now the increased sales is 55,000. On that increased sales, just apply the percentage of 40, which is my contribution margin. So you will get the contribution, which is 22 in our case. I hope that makes sense. Next. Okay, this is the PV ratio, per unit PV ratio. Sometimes what happens in the exam, they will not give you the sales value, but instead they will give you per unit prices. For example, sale value per unit, variable cost per unit, then contribution per unit will be automatically calculated. In such a circumstance, what to do? So then PV ratio would be contribution per unit divided by selling price per unit into 100. That's it. So contribution per unit we already know. It is nothing but selling price minus variable cost. You can also write it that way. So that is what we have done here. So okay, let's move ahead. There is one more formula which is PV for calculation of PV ratio, which is delta contribution. This is very important actually, because in exam what I observed is sometimes they will not give you the entire data of selling price minus variable cost, but instead what they will do is they will give you different levels of sales. Like if you are selling at 10,000 level, this is my profit and this is my contribution, or and if you are selling at some other level, this is my contribution. In such a circumstance, you will not have the data to calculate in a traditional manner. In such a circumstance, we'll have to use the delta formula. So that is delta contribution divided by delta sales into 100. Okay, so that is the thing. We'll come to break even in a second. Next. So there are different things which we have seen. Let us look at the meanings of all those before we proceed towards the problems. Profit volume ratio. We have already seen the formula for this. What exactly we mean by profit volume ratio? Let's see. The ratio shows the amount of contribution per rupee of sales. With every increase in rupee, how much of sales am I able to make? That is what the ratio tells us. Which ratio? PV ratio, or also known as contribution ratio. Then what else do they say? In the short term, fixed cost does not change. We have already seen it changes in the long run though. The profit ratio, or rather profit volume ratio, also measures the rate of change of profit due to the change in the volume of sales. That means by how much the sales changes, the same amount the profit also changes. That is what we get to know through PV ratio. If the PV ratio indicates high profitability, then that means what? There is, even with a slight increase in volume, without increase in fixed cost, would result in high profits, because the PV ratio itself is high. That means what? With every increase in sales, your profit will also be too high. Whereas if it is a low PV ratio, then it is very difficult to get too much of profit, because how much ever you may increase your sales, your profit will not increase to that great extent. So that is why it's difficult in such a scenario. So when you have low PV ratio, what you better do would be to increase your PV ratio instead of increasing the sales. If you increase the sales, you will not be able to increase profit. Whereas if you concentrate on increasing the PV ratio, ultimately it will increase your profitability, improve your profitability as well. That is the thing. Now there is a graph here for all the terms which we have used or will use in future. For example, if you look here, On the x-axis we have units sold, and on the y-axis we have the price. So there is one line here which is the total revenue, and there is one more line here called the break even point. And then we have this line here which is parallel to the units sold, which is nothing but the fixed cost. As you can see, fixed cost over a period of production remains fixed, it does not change. But the problem here is, until your sales, this is my sales, until it reaches this point, it has not even covered my fixed cost. So initially we will be running completely under loss, not even able to cover the fixed cost. Then somewhere along the line we are able to cover fixed cost, but now my variable cost has also come into picture. So because of variable cost, my total cost is increasing. But there will be a point where my revenue and my cost will be one and the same. So that point is referred to as break even point. Break even point is a point wherein total costs equals total revenue. So if the concern is able to produce at break even point, it's fine, but not ideal, because for how long will you be able to produce at the same level without worrying about the profit? At some point of time you need more than break even level of sales. So that is this level wherein we have achieved profitability, because my total revenue right now is surpassing my total costs. So that would be the ideal state. Okay. Anyway, let's move on. So here is the definition for break-even point. Let's read what it says. Break-even analysis in economics, business and cost accounting refers to the point in which the total cost and the total revenue are equal. We just now saw. A break-even point analysis is used to determine the number of units or rupees of revenue needed to cover total costs. So without this you will never know how much you need to achieve in terms of sales, because you need to have the data, right? Like how much sales should I affect so that at least my costs are covered. Which type of cost should be covered? Both fixed as well as variable. Once they are covered, that means what? We have achieved a state wherein we are getting neither profit nor are we incurring any losses. There is one more concept called margin of safety. Let's see what exactly it is. The margin of safety is the difference between the planned or actual level of production and the break-even quantity. Once again, it is nothing but the difference between the planned or actual level of sales and the break-even sales. That's it. So now if I have to look at the graph, the same graph or similar graph here. So this is my BP sales. Okay. And this is my, let's say, actual sales. So whatever we are producing here, this level between 25 units and 40 units, that is my margin of safety. That means between these two units I am fine, I don't have to worry. But if I fall below this, then definitely we are in danger. The bigger the amount of margin of safety, the better it is for the concern. Because if, let's say, my margin of safety was somewhere here, then I would have more cushion. Right now we have sufficient amount of cushion because it is anyway in units. So between 25,000 and 40,000 units, it is said we are in the safe zone because we are producing over and above BEP. Okay, so that is the meaning of margin of safety. Okay, fine. Now that we looked into various theoretical aspects of decision analysis or marginal costing analysis. By the way, this chapter also has activity-based costing and other topics, but the point is activity-based costing is a topic which is better suited for descriptive type of exam. So if I had to bring it up, let's say. Okay, this is the chapter, by the way, decision making tools. We have various things here: transfer pricing and activity based costing. These topics were there earlier also under a separate subject, by the way, but these are better suited for descriptive because you cannot ask objective type questions based on activity based costing. So that's the reason why I'm not concentrating today on that. So my focus is mostly on marginal costing. See, if you look here, this is the activity based costing again. So it's more like a statement. So 1 mark questions are difficult to ask, at least from my based on my opinion. So what I would suggest is, since there is less time, if you haven't studied this at all, I would suggest just read the theory and concentrate more on marginal costing problems. Okay, that would help you a lot. Anyway, let's come back. Now, where were we? Yeah, let's look at few of the problems. Let's see what exactly we have in store. Now, here is a problem for us. A company has a project to install a new machine exclusively for the manufacture of new product which is expected to have good demand and reasonably high margin. This say fine. Maximum possible annual sales may not exceed 50 lakhs, and if there is competition it may fall considerably. Okay, they are giving us the maximum sales. Fine. The company has obtained quotations and shortlisted 2 offers for the new machine. Okay. Details in respect of the 2 models are given below. Okay, we have 2 models. Between the 2 we have to choose one. In both the cases the maximum sales is anyway 50, because they say it can't exceed 50, but it may fall down considerably if there is competition. That's fine. But the difference starts with the fixed cost itself. In case of machine 1, the fixed cost is 5 lakhs, whereas in case of machine 2, the fixed cost per annum would be 8 lakhs. So there is considerable difference between machine 1 and machine 2. That is fine. Now, what else is there? Estimated profits for maximum sales. Okay. See, the point here is they have directly given profits. There is no question of variable cost. There is no question of what is that? Contribution. So what we have is only fixed cost and profits. Maximum sales in case of M1 will fetch us a profit of 15 lakhs, whereas in case of M2 it will fetch a profit of 17 lakhs. Fine. Let's see what exactly is being asked. Calculate BEP. Okay, fine. For both M1 and M2, BEP means that level of production or sales wherein there will be no profit and no gain, and sales at which both the models will fetch same profit. Okay, that would be interesting, wherein we'll have to look at sales with both the models fetching us the same level of sales. Let's see. Now, I guess the problem will be visible. Let me just confirm. If it is not visible, please do let me know. I can maximize it at least to some extent. Okay, I think it is visible. What do we have for BP? Let me write down a table here. M1 and M2. Okay, so now let us start with sales. How much is the sales given? In both the cases they say maximum sales has been achieved. So 50 lakhs. I'm keeping everything in lakhs so that it will be easy for calculation. Less variable cost, we do not know that. Okay, so I'm just leaving it blank for the time being. Then contribution, that also we do not know. Without variable cost there is no question of contribution. Then minus fixed cost, this we know because it is already given or mentioned in the problem. Fixed cost for machine 1 would be 5, for machine 2 it would be 8 lakhs. Okay, no need to mention lakhs also. You can mention on top. Anyway, yours is objective type, so you have to just do the math. Now profit is also mentioned, 15 lakhs and 17 lakhs. See, one thing which we can do is we can work backwards and find out few things. For example, we know, or we just now saw a few minutes ago, that contribution is nothing but fixed cost plus profit, because from the contribution if you deduct fixed cost you will end up with profit. This 15 and 17 is nothing but net profit. So net profit plus fixed cost will be nothing but contribution. In our case for M1 it would be 15 plus 5, 20, For M2 it would be 17 profit plus fixed cost 8, so contribution would be 25. So we have at least figured out one important thing, that is contribution. Now contribution is a key because with contribution we can easily identify profit volume ratio. So let us try to identify that now. So what is this profit volume ratio? It is nothing but contribution divided by sales into 100. So contribution we know in case of M1, let me start with M1 first. M1 it is 20 divided by sales is 50 into 100. Okay, whereas for M2 it is 25, sales will still be the same, by 50 into 100. Let me just bring up a calc. So 1 second, let me adjust the position. Twenty divided by 50 percentage, this would be 40 percentage. So this is anyway 50%. No need to calculate also. So we have now identified the PV ratio of both M1 and M2. With the help of PV ratio, we can easily identify the variable cost. For example, if you go back to the table here, so let me just bring it up. Where is this? See, now it says sales minus variable cost equals contribution. Now we have found out the contribution percentage. So with the help of contribution percentage, let's see how to calculate the variable cost. So now sales minus variable cost equals contribution. In case of M1, sales if it is 100 and contribution equals, how much was it, 40%, variable cost would be 60% of sales. Whereas in case of M2, if my sales is 100, contribution is 50, variable cost will also be 50% of sales. So this is the important thing which we achieved by identifying the PV ratio. What is it? Variable cost percentage as compared to on the base of sales. So 60% and 50% is what we need to apply with respect to both machine 1 and 2. So 60% of 50, 5 6 are 30, so this will be 30 and 25. You can even directly calculate that, but I just wanted to show you how to achieve this. Okay, so direct calculation would be very simple. 50 minus 20, 50 minus 25, that is there. That is the easy part, but we can also do it this way. Sometimes in the problem they may give some information only, so then you'll have to work it out. I hope it is clear. Okay, next, what else is there? So we have calculated the profit. Profit was anyway given. We have calculated the variable cost. We have calculated the contribution. So what is asked is BEP. Fine. We can easily find out BEP now that we have the contribution as well as PV ratio. So let me just write it down here. BEP in terms of, let's say, value would be nothing but fixed cost divided by PV ratio. Okay, so now fixed cost in case of M1 is 5 lakhs divided by PV ratio we earlier calculated is 40%, so divide that by 40%, that's it. So PVR is 40%, fixed cost is 5 lakhs, so 5 divided by 40, how much would that be? Divided by 40 as a percentage equals 12.5 lakhs. So that means what? If you effect a sales of 12.5 lakhs, then you will end up in a zone wherein you will neither earn profits nor incur any loss. That is the thing. Whereas in case of machine 2, that would be, how much was the fixed cost? 8 lakhs, no? 8 lakhs by 50%. So that is easily done. If 50% is 8 lakhs, then how much would be 100%? That would be 16 lakhs. So in case of machine 2, if you achieve a sales of 16 lakhs, you will end up in a zone where you are neither earning profit nor incurring any loss. That is the thing. I hope it is clear. Let me know if there is any doubt. Fine, let's move on then. What else is asked? Sales at which both the models will fetch the same profit. This is interesting. They have not told us how much is the profit, but they only say it should be same profit. It should not be two different levels of profit. Right now we have two different levels of profit, but we have to identify that level of sales between M1 and M2 wherein the profit remains the same. Okay, so that means what? We do not know how much are we selling in case of M1 and how much are we selling in case of M2. So in both the instances it would be X. Okay, minus variable cost. We have earlier identified the percentage of variable cost, that is 60% in case of M1 and 50% in case of M2. So variable cost would be X into 60%, or I can also say 0.6x. So here it will be X into 50% or 0.5x. So this gives us the contribution. Contribution would be 1 minus 0.6, that will be 0.4x. 1 minus 0.5, that would be 0.5x. But we already know the fixed cost, which will anyway remain fixed. So in case of M1 it is 5 lakhs and in case of M2 it is 8 lakhs. Okay, so that means what? My profit would be 0.4x minus 5. Here it would be 0.5x minus 8. That is the thing. But the problem here is both should be equal. For example, if I have to write this in the form of equation, it would be 0.4x minus 5 equals 0.5x minus 8, because the sales this level of sales will give us the same profit. So since it is the same profit, I am just putting that equal sign between the two equations. So can we simplify this further? Obviously yes. 0.4x, or let me just bring that this side, minus 5 plus 8 equals 0.5x minus 0.4x, or in other words 3 equals 0.1x. X equals 3 by 0.1. So that would be 30 lakhs. That's it. So that means what? At a level of 30 lakhs, that means if we sell to the tune of 30 lakhs, then we are at such a stage where profits in both M1 machine and under M2 machine will remain the same. So there won't be any changes between the two machines. At what level of sales? At 30 lakhs level of sales. I hope that was easy to understand. If you haven't understood, let me know. Otherwise, we'll proceed further. Let's move ahead. Okay. Next. Okay. Now in this case, PV ratio is given and margin of safety is given. Again, what is margin of safety? It is the difference between actual sales and the BEP sales. Whatever you have achieved above BEP, that would be the margin of safety, either budgeted or actual, depends. Now PV ratio is, they say 25%, that is PVR, and 6 lakhs is my MOS, margin of safety. So what is that they have asked? Profit is what they want. Okay, so for this we'll have to go by this formula for margin of safety. So now let me write down that margin of safety is nothing but profit divided by PV ratio. Okay, so in this case we know margin of safety, we know the PV ratio. What we do not know is the profit. Okay, so let us substitute the values here. 6 lakhs equals profit X, PV ratio is 25%. So therefore X equals 25% into 6 lakhs, or 6 lakhs into 25%. 625 is 150, so therefore X equals 150 lakhs. Sorry, 1,50,000. So that is my profit. Very simple problem, nothing much is happening. Let's move on to the next one. Okay, we have two sets of data here with respect to period 1 and period 2. Period 1 we have sales of 20,000 and profit 4,000, whereas in case of period 2 we have sales of 30,000 but profit of 8,000. Okay, now the point here is they have asked us to calculate sales to earn a profit of 16,000 will be dash. Again, this is slightly tricky because there is no variable cost, there is no fixed cost, obviously there is no contribution either. So based on whatever we have, we'll have to calculate. Okay, we can do one thing, we can use the delta formula and calculate the PV ratio. So when we have sales of two different levels or period in this case, we can easily find out the PV ratio. So PV ratio would be delta profit, that is change in profit divided by change in sales into 100. So when I say change in profit, it is a change in profit here and the change in sales here. Okay, by how much has the profit changed between one level and another level, or one period and another period? It has changed or increased by 4,000. So this will be 8,000 minus 4,000. The other one would be 30,000 minus 20,000, which can also be written as 4,000 divided by 10,000 into 100, which is nothing but 40%. So one thing which we have identified is we have found out the PV ratio with the help of delta formula. So the formula here is, since the given data doesn't have every information which we need normally to calculate the PV ratio, so we go by the change in the levels. So delta profit by delta sales into 100 will be PV ratio. That PV ratio is 40%. Now that we have the PV ratio, the rest is actually simple, not that difficult. For example, if I write down this as period 1 and period 2, my sales is anyway given. For period 1 it is 20,000 and period 2 it is 30,000. Okay, then minus variable cost equals contribution. Contribution is 40%. 40% of 20,000, 8,000. 40% of 30,000, 12,000. So difference would be variable cost. This will be 12,000. In this case, it will be 18,000. Or else you can also directly calculate 30,000 into 60%, 20,000 into 60%. That is also there. I mean, in the previous problem only we have seen how to do that. Whichever way, it's the same thing anyway. Minus fixed cost. So fixed cost is not given here. How to identify? Very simple. Why? Because we have already been told that the profit is 4,000 in period 1 and 8,000 in period 2. So the difference or the balancing figure will be fixed cost, and that will be constant in any case. So 4,000 and 4,000. So why did we do this? So that we can identify the fixed cost. That is the reason why we had to do this thing, do this calculation. Now that we have identified the fixed cost, we can easily answer the question. The question being, what is the sales required to earn a profit of 16,000? Let's do that. So I have to just write down the table as it is. Sales minus variable cost will be contribution. That minus fixed cost will be profit. So unfortunately here we do not know sales, we do not know variable cost, we only know the percentages. But one good thing is we know the profit amount. So the profit amount here is 16,000. And we also know the fixed cost, we just now calculated in the earlier step, that came to be 4,000. We also know that contribution minus fixed cost is profit. So therefore profit plus fixed cost will be contribution. So this plus this, that would be 20,000 is the contribution. If 20,000 is my contribution, so we already know the PV ratio. PV ratio in our case is 40%. We calculated initially using the delta formula. Now to calculate sales, all that we need to do is divide contribution by PV ratio. That's it. So contribution in our case is 20,000. So that 20,000 divided by 40% will give us the, what is it, sales. So 20,000 divided by 40% would be 50,000. So sales will be 50,000. Okay. Minus variable cost, obviously 60%, or the difference here would be 30,000. So that is the thing. So what was the question? Sales to earn a profit of 16,000, which is 50,000. So to earn a profit of 16,000, we have to do a sales of 60,000. Sorry, 50,000. That is the thing. Okay, I didn't notice the message which Rohan Patil had put up. Hi sir, I'm CS Executive Group 2 student. सर मेरा CMA का पार्ट पूरा बाकी है और पार्ट बी हो चुका है. सर हाउ शुड आई कवर रेस्ट ऑफ दिस सिलेबस. CMA का पार्ट ए पूरा बाकी है और पार्ट बी हो चुका है. पार्ट ए वुड बी अकाउंट्स नो. That is what takes time actually. Part B doesn't take much time. Since it is only management accounting, part B is actually easy to go through. It's only 40 marks also. Part A would require a lot of time. Now if you are revising, I would suggest revise based on past examination questions. Don't read the study material now because you definitely do not have time. Today is 26th, right? So in less than a month's time you would be done with the exam, I believe. So read the most important chapters. I would say the important chapters being share capital, debentures, then first few initial chapters would be very important. Then there will be many theory questions also. 50% theory, 50% practical. That's how this paper will be designed. For theory questions, it's definitely not difficult at all. All that you need to do is just memorize. There is nothing to do in theory. Should I do only theory? I don't think so. Because if you do only theory, out of that 60%, 60 marks, you will be only covering only 30%. What about the remaining 30? And we have negative marking, right? So that would be a huge risk, I would say. Solve the problems from share capital, debentures, and if possible, even consolidation. 1 second, let me just bring up the syllabus. So let me just recall the chapters which have. See, the first 5 chapters I would say are very important. So you should definitely look into that. Again, consolidation, it's easy to, I mean, if you already studied, you don't have to study again. Cash flow and all those things are easy. Accounting standard alone, just read the questions from the previous, what is that, scanner or any book where you have already have the questions and as well as the answers. Don't read the material now. Material is a strict no-no, at least at this point of time. You should be practicing more and more questions from the previous exams. I would suggest either Taxman's book or scanner, whichever you are comfortable with. So both are fine, I believe. I hope I have answered your query. Okay. Since you have already covered part B, you should be confident about part B. So it's okay. You can, I would say you can pass, not an issue. I'm assuming that you have at least covered the part A once. So that's okay. So are you appearing for both the groups? Okay, you have written MSc Executive Group 2 student. I think you are appearing only for Group 2. That's okay. You can easily cover. Not an issue. Okay. In fact, let me tell you, for my CS exam in Executive, back then we had only 3 plus 3. I had not studied for more than 2 months. That's all. Not more than that. I mean, final 2 months was where I was completely into studies. But earlier, I used to study for only for 2-3 hours. But that's me. It depends on every individual. So I was a lazy student, so that's why I couldn't study more. But at least in the last 2 months, I studied and I concentrated mostly on all these guideline answers. Back then, it was all descriptive, no. So I'm talking about 10 years old story. Not even 10. More than that. Okay. So it should be fine. Just be confident. Don't get scared. That's all. Fine. Let's move on. Did we solve this? Yeah, we solved this. No. Let's move on to the next one. Okay, what do we have here? Selling price data is given. Okay, that is 20 rupees. Trade discount 5% they say. Okay, that is also fine, not an issue. Cash discount is 2% on sales. Cash discount will not come here actually, because cash discount is purely an accounting concept. So I hope you know the difference between trade and cash discount. Trade discount is a discount which you get even before you made the purchase. Let's say you go to some sabzi mandi, and if you bargain, and if you reduce the price by, let's say, 10%, that is your trade discount. You have not even purchased, but even before that you have already got the discount. That would be relevant for costing, because we are looking at the price. Whereas cash discount is a discount which you will get after purchase. Let's say you purchase something on credit basis, maybe because you have some wrap, or maybe because you have made the payment quickly, you may get some credit discount. That is not relevant for us. Okay, material cost is given, which is 3 rupees. Labor cost is given. Then those are all obviously variable costs. Then what else do we have? Fixed cost is there, fine. Variable overheads is there. Okay, that is also a variable cost. So there are 3 variable costs here: material cost, labor cost, and variable overhead. Calculate net profit if sales are 10% above BEP level. Okay, that means we have to first find out BEP level and then apply 10% on top of BEP levels so that we can answer the question. Okay, fine. Let's do that. It's not that difficult actually. So in this case, first of all, selling price would not be 20, because there is some trade discount as well, which is 5% on selling price. 5 2s are 10, which is nothing but 1. So 20 minus 1, 19 rupees is the actual sale price. So as I said, cash discount anyway won't appear, so don't worry too much about the cash discount part. So now let us look at the level of sales and how much percentage we can actually. Oh, we will have to do with B. We start with BP actually, no? Fine. Let's do that. I don't want all this. Straight away I'll start from sales. Sales, this would be actual, then this will be BP. Okay, so now sales, we do not know how much it is, so we'll have to identify that. But selling price we know is 19. This will be per unit minus variable cost. So how to calculate variable cost? Simple. 3 rupees plus 4 rupees, then 80% of this. So 80% of this means 80% of 4 rupees. 4 8s are 32, so that means 3.2. So total all that. So total all that means 3 plus 4 plus 3.2. So that will be 10.2. Okay. 10.2 is my variable cost. 19 minus 10.2 would be 8.8. So that is my contribution. Let me just write down contribution first. Contribution 8.8. That is per unit. Okay. So then minus fixed cost. Fixed cost is given, so I can write it 22,000. Okay. Then what else? Profit. See, one thing is for sure. In case of in case of BP, there won't be any profit. So if there is no profit, profit will be nothing but 0. Nil. So from contribution, if you deduct fixed cost, you will end up with profit. If profit is 0, my contribution should also be 22,000. So that 22,000 plus 22,000 minus 22,000 will be 0. That is something which we have identified. So what we have to identify here is sales and variable cost. Okay. For that, we can take the help of PV ratio. Again, PV ratio is our friend here in marginal costing. For everything, we'll have to come back to PV ratio only. So PV ratio is nothing but contribution by sales into 100. So now where do we have the contribution? Here we have, that is per unit, but still applicable to actual sales as well as BP sales. Contribution is 8.8 and sales is 19. So do that math. 8.8 divided by 19 into 100. So this will be 8.8 divided by 19 percentage. So this is 46.3158. I'm just keeping the decimal part so that it will be easy for calculation. So this is my profit volume ratio. So with the help of profit volume ratio, we can easily identify sales as well. How? We'll see. because we know the contribution in case of BP level. So let us try to identify the sales there. For example, PV ratio equals contribution by sales, whereas sales equals contribution by PV ratio. So now in our case, contribution we know is 22,000 divided by PV ratio of 46.3158. No, 46.3158%. So when you do this, you will get the BEP sales, because this contribution of 22,000 is the BEP contribution. So let me do that math. 22,000 divided by 46.3158 percentage will be 47,500. See, 47,499.9, I'm rounding it off to whole number, which is 47,500. So this is my BEP sales. Let me go back and write down here. 47,500 is my BEP sales. If my contribution is 22,000, my variable cost would be 25,500. This is the thing. Now the rest is actually very simple. Why? Because they have asked us to calculate net profit if sales are 10% above BEP level. So now we know the BEP level. So 10% above that is easy to identify. So 47,500, on top of that add 10%. That's it. So 47,500 plus 4750 will be 52,250. That's it. Then minus variable cost, that will be percentage. Let's go back to the percentage here. 52 point something into 46.3158%. So 24,200 will be my contribution. So remaining would be my variable cost. So 52,250 minus 24,200. So 28,050 will be my variable cost. So now profit easy to calculate. 24,200 minus 22,000, that will be 2,200 is my profit. That's it. So that is what was asked. Profit at that level. Which level? At BP plus 10%. So we have achieved that. Okay. If you have any doubts, please do ask. Fine, then I hope this session was useful. If at all you watch this session later on, and if you get any doubt with respect to whatever we have covered, or any doubt with respect to marginal costing, you may leave a comment below. I'll try to get back to you. Thank you. Please do visit our website excelacademy.com. The description has all the links and the numbers. If at all you have any doubts with respect to anything to do with company secretary course, please do get in touch with us. We have the WhatsApp numbers, Telegram channels and whatnot. So there are various ways in which you can contact us. So feel free to contact us, and just log into excelacademy.com. We have various materials there which are available only if you log in. Okay, Jones Victor says Tamil. Unfortunately, I don't know Tamil. I can understand Tamil, that's all. So if you want Tamil, you better subscribe to our Tamil channel, where CS Abhishek has created lots of videos. I hope you have subscribed to the Tamil channel. We have a Tamil channel, Telugu channel, Kannada channel. So how can we not have a Kannada channel when we are based out of Mysore? Okay. So fortunate that we have different faculties who speak different languages. For example, Alok speaks Telugu, so we have Telugu. Then Abhishek speaks Tamil, so we have Tamil channel. So hopefully with passage of time we'll have more videos there. But since all of us speak English and understand English, especially in South India, I think this should be fine. Anyway, thank you guys for watching the video. All the best for the exams.